Hi, this is the first complete comprehensive example for adjustment of capital sums in the first method at the time of retirement of partner. The first method of adjustment of capital is where the total capital of the new firm is given. So let's go to the example sum. Example sum. Lisa, Monica and Nisha were partners in a firm sharing profits and losses in the ratio of 2:2:1. On 31st March 2019, their balance sheet was as follows. To the left of the screen, the balance sheet is given. On the right, additional information. On 31st March 2019, Monica retired from the firm and the remaining partners decided to carry on the business. It was agreed that, first point, land and building be appreciated by rupees 2,40,000 and machinery be depreciated by 10%. Point 2, 50% of the stock was taken over by the retiring partner at book value. Point 3, provision for doubtful debts was to be made at 5% on debtors. Point 4, goodwill of the firm be valued at rupees 3 lakh and Monica's share of goodwill be adjusted in the accounts of Lisa and Nisha. Fifth point, the total capital of the new firm be fixed at rupees 27 lakh, which will be in the proportion of the new profit sharing ratio of Lisa and Nisha. For this purpose, current accounts of the partners were to be opened. We are asked to prepare the revaluation account, partners' capital accounts and the balance sheet of the reconstituted firm on Monica's retirement. So we need to note the point 5. It says the total capital of the new firm is to be fixed at 27 lakh, which has to be in the NPSR of Lisa and Nisha. Further, it says that the adjustment has to be made through partners' current accounts. So this is the first method of adjustment of capital sum, where the total capital of the new firm will be given. And in this sum, we need to make the adjustment through partners' current accounts. We'll open the revaluation account, go ahead with the partners' capital accounts, followed by the balance sheet. Working notes will be done after the balance sheet. So let's go ahead with the solution. Solution. Revaluation account. Left side debit side, right side credit side. We have particulars, rupees, particulars, rupees. As per point 1, land and building be appreciated by rupees 2,40,000. So we have by land and building account 2,40,000 rupees. And machinery be depreciated by 10%. So to machinery account 10% of 12 lakh is 1,20,000 rupees. Second point, 50% of the stock was to be taken over by the retiring partner at book value. There is no change in value. The retiring partner is taking it up at book value, so it will not affect the revaluation account. The third point, provision for doubtful debts was to be made at 5% on debtors. So to provision for doubtful debts account, 5% on the debtors. Debtors amount is 4 lakh rupees, so 5% is 20,000 rupees. The fourth point is about the goodwill and the fifth is about the adjustment of capital. So the entries are done. Let's balance the revaluation account. Greater total 2,40,000 on the credit side. There's a gain on revaluation. To gain on revaluation, transferred to partners' capital accounts. The first partner, Lisa, second partner, Monica, and third partner, Nisha. The total gain on revaluation, 2,40,000 rupees minus 1,40,000 rupees, rupees 1 lakh. Rupees 1 lakh to be divided in OPSR 2:2:1. 40,000 for Lisa, 40,000 for Monica, and 20,000 rupees in the case of Nisha. So this is a revaluation account. Next, let's go to the partners' capital accounts. Partners' capital accounts. Left side debit side and right side credit side. Particulars. Lisa, Monica, and Nisha. Again on the credit side, particulars. Lisa, Monica, and Nisha. We'll begin by bringing down the balance of the capital accounts. By balance brought down, 14 lakh in the case of Lisa, 14 lakh in the case of Monica, and 3,60,000 rupees in the case of Nisha. We'll transfer the gain on revaluation by revaluation account. As per the revaluation account, it was 40,000 rupees for Lisa, 40,000 rupees for Monica, and 20,000 rupees for Nisha. There are no reserves or accumulated profits or even accumulated losses of fictitious assets. Let's go to the goodwill treatment. There is no existing goodwill. The goodwill treatment is as per point 4. Goodwill of the firm is to be valued at rupees 3 lakh and Monica's share of goodwill to be adjusted in the accounts of Lisa and Nisha. So let's do working notes for goodwill treatment. So it's working note 1, treatment of goodwill. As per the sum, firm's goodwill is equal to rupees 3 lakh. The OPSR or the old profit sharing ratio between Lisa, Monica and Nisha is given in the sum as 2:2:1. The partner who's retiring is Monica. So Monica's share of goodwill is equal to 3 lakh rupees multiplied by Monica's share in profits 2 divided by 5, which is equal to rupees 1,20,000. There is no mention about the gain or gaining ratio or new profit sharing ratio between the continuing partners Lisa and Nisha. Therefore, the gaining ratio between Lisa and Nisha is equal to their old ratio, which is equal to 2:1. So the treatment of goodwill, the journal entry, we'll debit Lisa's capital account, we'll debit Nisha's capital account, the two gaining partners, and credit the retiring partner to Monica's capital account. Against Monica, we'll write Monica's share of goodwill, 1,20,000 rupees. And this has to be divided between Lisa and Nisha in their gaining ratio 2:1. So 80,000 against Lisa and 40,000 rupees against Nisha. So let's post this into the capital accounts. So it's by Lisa account, capital account. Under Monica, the retiring partner, we'll have 80,000 rupees. And by Nisha, capital account. Under Monica, again 40,000 rupees. And on the debit side, to Monica's capital account. Under Lisa, we'll write 80,000 rupees. And under Nisha, we'll write 40,000 rupees. So we've treated the goodwill. Let's deal with point 2, which says 50% of the stock was taken over by the retiring partner at book value. Journal entry for stock taken over, Monica's capital account to stock account. So we have to stock account, half of 10 lakh, so rupees 5 lakh is taken over. All the entries are done. As per point 5, we need to adjust the capital. So we'll keep the partner's capital account on the first half of the screen and the working notes on the bottom half of the screen. So we have working note 2 as adjustment of capital. Step 1, we need to get the new capital of Lisa and Nisha. As per the question, it says the total capital of the new firm is to be fixed at 27 lakh in the NPSR, and since there is no mention between the gaining ratio or gain etc., the NPSR is 2:1 between Lisa and Nisha. So it's 27 lakh in 2:1. In the case of Lisa, it's 27 lakh into 2/3. NPSR between Lisa and Nisha is equal to 2:1. This is equal to 18 lakh. And in the case of Nisha, 27 lakh into 1/3, which is equal to rupees 9 lakh. So we've got the new capitals of Lisa and Nisha. Step 2 is to get the adjusted capitals. That is the capitals of Lisa and Nisha after all adjustments. In the case of Lisa, it is 14 lakh 40,000 rupees minus 80,000 rupees, which is equal to rupees 13 lakh 60,000. And in the case of Nisha, it's 3 lakh 80,000 rupees minus 40,000, which comes to rupees 3 lakh 40,000 rupees. And the final step 3 is to compare adjusted capitals and the new capitals. We'll begin with Lisa. Lisa's adjusted capital is 13,60,000, whereas the new capital is 18 lakh. So we need to debit the current account with the difference. So debit Lisa's current account with the difference, which is 18 lakh minus 13,60,000, which is 4,40,000. And in the case of Nisha, the adjusted capital is 3,40,000, whereas the new capital is 9 lakh. Again, we need to debit Nisha's current account with the amount of the difference, which is 9 lakh minus 3,40,000, which is rupees 5,60,000. Before we go further to adjust the capital accounts, let's balance the retiring partner's account and transfer the balance to loan account. Remember, when nothing is specified regarding settlement of account of retiring partner, we need to transfer the balance to loan account. So we'll transfer the balancing figure of Monica's account, capital account, to Monica's loan account. Greater total 15,60,000 to Monica's loan account. The difference 10,60,000. Let's go ahead with the adjustment of capital. We need to debit Lisa's current account and credit Lisa's capital account. So by current account, 4,40,000, and we need to debit Nisha's current account and credit Nisha's capital account with 5,60,000. Let's write the balance carried down, the amount of the new capitals. As per the sum, it was 18 lakh for Lisa and 9 lakh for Nisha. If both sides tally, then we know that our arithmetic is right. $18,80,000. Credit side total for Lisa and debit side total for Lisa is also 18,80,000. 9,40,000 credit side total for Nisha and 9,40,000 is the debit side total also for Nisha. So these are the partners' capital accounts. We had to make the adjustment through partners' current accounts. We had to debit both their current accounts, Lisa's and Nisha's, and credit their capital accounts. The amount due to Monica was transferred to Monica's loan account. Let's go ahead with preparation of balance sheet. Balance sheet as at 1st April 2019. Left side we have the liability side. Right side, asset side. We'll begin with the liability side items. Trade creditors. No change in the value, 1,60,000 rupees. Bills payable. Again, no change in value, 2,44,000 rupees. Employees Provident Fund. No change in value, 76,000 rupees. Monica's loan account, let's refer to the amount which we transferred to Monica's loan account. So this was it. Monica's loan account 10,60,000. 10,60,000 rupees. The capital accounts, Lisha 18 lakh. It was the new capitals of the partners, the balance carried down. And Nisha was 9 lakh rupees. Total 27 lakh rupees. Let's continue with the asset side items. Land and building. As per point 1, we had to appreciate it by 2,40,000. So current value is 12,40,000 rupees. Machinery was depreciated by 10%, 1,20,000. So it's now 10,80,000 rupees. Stock, 50% of the stock was taken over by the retiring partner. Balance left is only 50%, which is rupees 5 lakh. Debtors, the original amount of debtors was rupees 4 lakh. We made a provision for doubtful debts at 5% on debtors, which is 20,000 rupees. The final amount 3,80,000 rupees. Bank, there is no change in the bank balance, 40,000 rupees. Finally, let's insert Lisa's current account and Nisha's current account. We had debited these two current accounts, 4,40,000 and 5,60,000. Lisa's current account, 4,40,000 rupees, and Nisha's current account, 5,60,000 rupees. Let's check this balance sheet tallies. Liability side total 42,40,000 rupees. Asset side total is also 42,40,000 rupees. So this is a balance sheet. I'll remove the split and we can view the full answer. So we began with the revaluation account. Next was the partners' capital accounts. Followed by the balance sheet. And the working notes. The first working note for treatment of goodwill, and the second working note for adjustment of capitals.